Oh, great. Thanks, Rand. So yeah, exactly. So the title of this segment is navigating international equity allocation, and I'm sorry I couldn't come up with something more exciting. But really, what this is based on a question, a very good question actually that we got from a client that I answered, and I felt that doing some of the research that I did, it would be useful to other people as well. So just to go through the key points of what this investor was asking. So they consider themselves a long-term investor. They're not a market timer. They allocate 10% of their portfolio to international stocks, and they do this via an EAFE ETF. So this is Europe, Australasia, Far East ETF to get that international exposure. So the other 90% is in Canada and the US, and my understanding is that a high allocation to the US. The EAFE, though, has underperformed the US significantly over the last 15 years. So just for example, 2024, I think 24% was the S&P 500. EAFE was essentially flat. But what this investor noticed is that when Europe declines, that Europe has tended to decline more in downturns. So when the market goes down, Europe goes down more than the US, but it also lags in the recovery. So he doesn't want to be a market timer, but at the same time is wondering, does it really make sense to stick with this 10% allocation in international investing? Why not just get rid of that and put it more into the US where the returns have been far greater? So really what this is a question of is diversification benefits versus this consistent underperformance that we've seen. So just to be clear, the EAFE ETF is largely weighted to Japan and Europe, where growth has been slower. But why don't we just talk a little bit about why diversification is generally recommended in the financial community so that people understand what the purpose of it really is. So different asset classes, sometimes like say bonds and equities, or even different types of stocks, can have what's called a low or an inverse correlation. And basically what this means is that they just move up and down at different times. So, potentially when one is going up, the other is going down, but they don't move up and down together. They do it separately. And when you combine these assets that have low correlations, what you can do is you can smooth out the volatility in the overall portfolio. So, your investments that have the highest risk, that fluctuate the most, that will be smoothed out by some of your other investments, assuming that the correlation between the assets is low. If they're moving up and down at the same time, then this doesn't work, right? So, but what diversification can do, but it does not always do, is it reduces the risk of this market-based volatility. So volatility, just like how much is your portfolio fluctuating, right? From week to week, but really even from year to year. And this can potentially increase the risk-adjusted return. So risk-adjusted return is the return for every unit, essentially, of volatility, or just the return relative to how risky it is. But what diversification is not intended to do is increase overall return, right? So in fact, overall return is always going to be lower in a diversified portfolio than the highest returning asset in the portfolio. The highest returning asset, if you had with foresight invested all of your capital in that, you would have been better off. But the problem is you don't have foresight. So you're not going to necessarily know what your highest performing asset is going to be. So by combining different assets that don't move up and down together, and also have a positive return, you can actually increase your risk-adjusted return, but not your overall return. So I just have an example here. If you look at this chart, so this is basically a fictional 1-year chart of weekly returns over the period of a year. And stock number one, this is a high return, higher volatility stock. So this is the chart up at the top here, the yellow chart. This is the highest returning stock in this example here. Stock number two is lower return. This is the one at the bottom, the orange line. Essentially, almost flat, but it is much less volatile than the higher return company. Okay, so if you were, because these stocks happen, these fictional stocks happen to have a low correlation to each other, if you were to combine them together, you would get essentially this middle line, a portfolio that looked like this if it was a 50-50 split, the red line, basically balancing between the two. So a higher return than the lower return, lower risk stock, lower return but lower volatility than the higher return, higher risk stock. So that is basically what diversification is intended to do, not increase the return, but decrease the risk. And if you look here, the way that risk adjusted return is generally measured in the industry, and that's by Sharpe ratio. Combining in this specific scenario with all of these numbers, combining those two stocks, you actually get a higher risk adjusted return, 0.43, relative to either of the options of having the higher return stock, just 100% in the higher return stock, or just 100% in the lower return stock. So in this case, the diversification generated the higher risk adjusted return, but the lower nominal return. So the disclaimer is, I created this data specifically for this example, and I created it to work like this, but diversification doesn't always work like this. So this does not necessarily apply to the question regarding the EAFE and the S&P 500, because we would have to use those numbers in terms of correlation and returns and volatility. So the problem with diversification is that asset classes are often highly correlated with each other. They often do move up and down, even when you wouldn't expect them to. And this will reduce or even eliminate the benefit of diversification. And also future correlations, because you need to find assets that have low correlations with each other. You don't know what the correlations are going to be in the future. These can be difficult to predict. But finally, and I think that this is more relevant and easy to understand for most investors, is that depending on your specific risk tolerance and your specific individual situation, investors need very different levels of diversification depending on these characteristics. So in some cases, investors are highly sensitive to volatility in their portfolio, but in other cases, they are able to take on much more risk and the volatility does not bother them. So this is just basically a breakdown of the S&P 500, so we can look at what this investor is talking about over the last 10 years, 10, 12 years here. So the S&P 500 over this period of time returning 308% compared to the EAFE ETF, which returned only 41%. So we can see absolutely dismal returns from the international ETF relative to the US. But another thing that I'm seeing here and is that I don't necessarily think that you're getting a lot of the benefit of diversification as well from this. And I haven't tested this statistically, but if you just look at the stock prices here, at the price charts here, they do tend to go up and down together, which would imply to me that they are actually highly correlated. Therefore, you would not get the full benefit or perhaps much benefit from diversification. Now, this is just a one-year chart. More than likely, the more important correlation is how they're going to interact with each other or correlate with each other over the longer term. But it does seem that if there is a major economic event in the United States, and this would affect the rest of the world as well, so likely there would be some high correlation. So is this a cycle or a trend? Well, post Great Financial Crisis, 2007, 2008, the US has outpaced Europe significantly. This is due to faster economic growth, dominance of the big technology companies, and just many challenges that the Eurozone has had. Now, sometimes there is mean reversion and market leadership can shift. We can't predict the future. Europe did, and emerging markets did lead returns in the early 2000s. Valuations as well are something to consider. Europe trades generally at lower valuations compared to the US, in some cases for good reason, but having some diversification into a more value focused area would potentially be worthwhile. But I essentially, as with many questions in investing, is there is no clear-cut answer because it's really going to depend on the individual. So there are three options that this investor could really take. They could eliminate all of their international diversification, completely remove international exposure, and concentrate just in the US and Canadian markets. And if future performance reflects past performance, then they certainly will do better with this. But it is higher risk, and we don't know if there will be some mean reversion or a downturn in the US, perhaps due to higher valuation or some other type of event, whereby having international diversification would actually be worthwhile. But another option would also be to reduce exposure to the EAFE while maintaining some international exposure. So one way to do that would be to go down from 10 to 5%, or maybe looking to other types of ETFs, like an all-world ex-US ETF or global ETF or emerging market ETF, and combine those. Those are two options, but really, this is something that it comes down a lot to the individual investor and how much you feel that you can withstand the volatility in your portfolio. For some people that are able to withstand volatility, diversification is certainly less important. But if you want to get diversification, the benefits of diversification, again, it is important to pair the right assets together, and that takes some analysis. So that was my assessment of the situation.
Yeah, I think like one thing too is, just investors have to be like, or they have to understand the stocks that they actually own in their own portfolio as well. Is like, there's a lot of companies that will trade in the US or in Canada that will have international exposure. So I mean, it's good to keep that in mind too, when you
Yes, in
are,
fact, most US stocks that you're investing in
Mhm.
the large cap space are in fact going to be global companies, which may be
Yeah.
another reason why the US market has outperformed so much.
Mhm. Yeah,
That's
exactly.
absolutely correct. And in Canada, and that's something, of course, at Keystone, the way that we get diversification just from stocks on North American exchanges.
Yeah.
Yeah, for sure. And large, even smaller companies can have, exposure internationally and can grow their businesses internationally. So, there is the potential to buy like an international ETF or fund, but if you craft your portfolio in a smart, systematic way, you're likely getting exposure through either large or targeted small to mid cap companies that are operating in Europe or having exposure to Europe, and you potentially don't have to. You haven't been exposed also to a slower economy there overall. You've had a diversified company that has growth in the U.S. market, growth there, and even is growing potentially in that market. Better companies potentially too. But I mean, there is always, like Aaron said, the chance to find cheaper companies that are depressed on. And like I went over the general U.S. valuations; they are high. So if there is a company that you can find, and we're looking at a few companies right now that that there's a company out of Sweden that we were just looking at recently that has generally low valuations, and part of it could be because European equities have been out of favor. And if that's just the reason, if it's a great company and it's growing and it has good valuations and it just happens to trade in an area of the world that has generally lower valuations, that can be a long-term opportunity. So you got to
Yeah.
balance many
Like
things when you're
even
looking at companies.
like even like another company, I won't say the name, but from our Canadian small cap research, quite a stable business, providing services essentially to hospitals. But they operate in literally Prince Albert, Saskatchewan, where I was born and raised, but they also have operations in Europe as well. So
Yeah.
like even just a company like that, and again, I'm not going to say the name, but
Yeah, and they have
it's just
significant exposure to Europe as well. So yeah,
exactly. So it's just,
and it's traded on the TSX. So
exactly.
you have exposure within Canada, but you also have European exposure too. So
Yeah.
interesting the way
Yeah,
you can gain exposure to those markets.
that's actually something which has really changed over time. Is you've seen increased correlations between international indexes. So if you're looking at like the EAFE, you had, I'm just pulling it off the website. It was from 1970 to 1989. It was 0.49 0.49 correlation, so 49% correlation. And then it increased from 90 to 99 to 0.54, and then 2000 to 2022 was 0.87. And I just ran it through my own regression calculator. Last decade, it's been 0.85, which is quite high correlation. That's to the S&P 500.
Wow.
So you can see over time, as globalization happened, these correlations between indexes increased. So when you're looking at the EAFE or any others, you're likely higher than what it used to be. So if you're hearing you should diversify internationally at these index levels, the diversification benefit isn't as great as it used to be, unfortunately.
Yeah.
But that doesn't mean that there isn't diversification benefits. And even then, these ETFs are massive. So that EAFE ETF has 748 holdings, which on their own have their own correlations. They have their own countries. You have to remember when you're looking at the S&P 500, that's one domestic. Obviously, like they were just discussing, Ryan and Brennan, is they have external exposure, but it's just domestically traded on the U.S. exchange companies versus you have Japan, you have all the European countries, you have Australia, you have a lot more breadth of different companies and within the countries even. So one might be great diversification benefit, one might be poor. And that's the issue with these ETFs as well, is it's not as good as it used to be. And then you might need to go a bit deeper. You might want to diversify just to one country that has low correlation with Canada or the US versus these broad-based international ETFs.
And I would say if you pulled out the top 10, the FANGs or the top 10 tech stocks out of the S&P 500 versus a European index, there wouldn't be as much of a divergence.
It actually performed worse the last couple of years, the S&P 500.
Right?
Yeah, that's interesting. That's interesting. Yeah. So then you can basically, if you're taking the approach that you're just chasing the very highest quality asset, then you can just say, well, let's forget even about the US market and just buy the FANG stocks. But that would be then, that's an example. That would be a very risky strategy. If they continue to grow like they've been growing, you'll be one of the highest performing portfolios. But, we saw what happened when, in the most recent tech downturn, it was very swift, and you can lose 50%. Or more, and some of those tech companies were down 90%. Many haven't recovered.